Hi guys, I'm Nicola McKenzie, founder and mortgage advisor at Dunham McCarthy Mortgages. And in today's video, I will be explaining how lifetime mortgages work. So stay tuned to find out more. So guys, we here at Dunham McCarthy are property, mortgage, insurance specialists. So we're a team of mortgage advisors and brokers that deal with lots of different options from high street banks to specialist lenders and help you to provide our expert knowledge and advice on your best options. So head over to our website and book in, it's dm.mortgage, and we can give you a free of charge appointment to go through and explain to you how we can help and look at your situation to provide advice. So I released a video a couple of weeks ago that was titled Mortgages for Over 40s. Check that video out if you haven't already, but because of that video, I had an overwhelming number of calls from you guys relating to that video, saying how helpful it was, but also it really just highlighted to me that there are many people that are over 55 that struggle to get a mortgage traditionally when they go through their high street bank, etc. And there are potentially options. So if you're in that situation, do not lose hope, we can help you. So if you're looking to release equity from your property, or you can even use a lifetime mortgage to purchase a property as well. If it's something that you want to consider, then make sure to get in touch and, like I said, book in for an appointment. But let's look at the detail. So what is a lifetime mortgage? Well, a very brief summary, a lifetime mortgage is exactly what it suggests. It's a mortgage, it's secured against your home and it runs for your lifetime, or until your house is sold to repay the debt. And that's usually either on death or admission to long-term care. Now, it differs from a traditional mortgage in that with a traditional mortgage, each month you'll make a monthly payment. If it's a repayment mortgage, part of that monthly payment will go towards paying off the interest. Part of that monthly payment will go towards reducing the capital. It works differently to a traditional mortgage in that respect. A lifetime mortgage, the interest is charged on an increasing sum as you don't usually make repayments with a lifetime mortgage, and that's one of the main benefits for many people. There are some lifetime mortgages where you can make repayments, but traditionally you would not make any repayments against the mortgage, and because of this, the interest gets added to the debt continuously. Now, there are generally two different types of lifetime mortgages. You've got what's called an interest roll-up mortgage, and that's where you get a lump sum or you're paid a regular amount and you get charged interest which is added to the loan. This means that you don't make any regular repayments and the amount that you've borrowed, including the rolled up interest, is repaid at the end of the mortgage, so when your house is sold. Now, the other option in relation to lifetime mortgages in respect of how the interest is repaid is an interest paying mortgage. So you get a lump sum or a regular amount, and what you do is either monthly or on an ad hoc basis, you'll make payments, and this reduces or stops the impact of interest roll up completely. So some plans might allow you to even pay off some of the capital if you wish. And the amount that you've borrowed again gets repaid when your home is sold at the end of the mortgage term, usually either on death or in the event of you needing long-term care. Now, most lifetime mortgages are offered using a fixed rate of interest for the lifetime of the mortgage, which is again great because traditionally with a mortgage, you'll fix for 2, 3 or 5 years, but to be able to fix for a lifetime can provide you with certainty over what your interest rate's going to be for the longer term. Now, many products as well with a lifetime mortgage come with what's called a no negative equity guarantee. Now, if you don't know what equity is or negative equity is, I have got a video on my channel which explains this. But ultimately, if a lifetime mortgage comes with a no negative equity guarantee, what that means is, again, it's giving you peace of mind that the amount that you owe will never exceed what the house is worth. So it's just, again, giving you more peace of mind. Now, when you're taking out a lifetime mortgage, you can choose to borrow a lump sum at the start, or you can initially get a lower amount and then use the option of having a drawdown facility. So you might want to draw down throughout the years if and as and when you need to use extra funds. Now, with a drawdown facility, if you don't need to release the full amount that might be available to you, it means that you can, like I said, withdraw the money within a certain borrowing limit rather than taking one big loan, as it means you'll only be paying interest on the amount that you actually use and that you actually need. So that's also a good option. Now let's look at some of the common reasons why a lifetime mortgage might be useful. It's quite commonly used for things like funding retirement, to fund your child or children's house deposit, to pay off an interest-only mortgage or other debts, to consider buying a second property, just to take cash, tax-free cash for any other reason. And one of the other useful ways that a lifetime mortgage can be used is that it can reduce the risk of equity in your home being used to fund long-term care. If you've spent the money or the equity in your home, then obviously you've already used it. So if you did need long-term care, then there would potentially be less available to be used to fund that. And therefore, you might find that you get more state help in that scenario. So now let's talk a little bit about eligibility. Now, where eligibility is concerned, obviously every provider is going to have their individual criteria, but here I'll just pick out some of the general key points that are usually applicable across the board. So you usually have to be at least 55 years old and have a property worth at least £70,000. Now, how much you can release is going to be determined by the value of your property, your age, your health, your lifestyle and other criteria, but again, those are the main points to consider. It's not down to affordability, and that's why it can be very helpful for people that are over 55 that are perhaps in their retirement or they've taken an income drop for some other reason. Now, if you're trying to release equity using a traditional mortgage, affordability is usually going to be a lot more detailed than it is with a lifetime mortgage. So like I say, if you're approaching retirement or if you're in retirement, this can be difficult. So it's a good alternative to consider if you're in that position. Now, generally, the older you are and the poorer health you are in, then most providers will allow you to release more equity. And typically speaking, the maximum that you can withdraw in equity is 55% of the value of your home. So if you have a house worth £300,000, that usually means up to £165,000. But as I stated, eligibility is going to vary amongst providers. I'm just giving you some general themes and points that are usually consistent amongst most providers. Now, there are a few things that if you're considering a lifetime mortgage, you might want to consider. And some of the main points to consider are as follows. The most important thing to think about is that it might affect what you leave as inheritance. So depending on who you're planning on leaving your property to, that might be a big factor in consideration in your thought processes. If you've taken the equity from your home and spent it, then that is going to potentially reduce potential inheritance. Now, with an interest roll-up mortgage, the total amount that you owe can grow quite quickly. So the point I mentioned earlier about having a no negative equity guarantee, it's really important that if you are considering a lifetime mortgage, if you want peace of mind, that it has a no negative equity guarantee. And that will just make sure that you'll never owe more than what your house is worth. And then the last point to consider, or the main point of consideration, shall I say, is that it might affect your tax position and entitlement to means-tested benefits. Now, that's going to be based on your individual circumstances, but it is just something to think about. So I hope that explanation of lifetime mortgages has been really useful for you. If it is and you want to explore a lifetime mortgage and look at your options in more detail, then make sure that you get in touch. You can give us a call, drop us an email, head us over to our website and book in for a free of charge appointment where we can talk you through and explain what your options are and see how we can help. But I hope that's been useful, and I'll look forward to catching up with you in my next video.